Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to be looking at a wide array of information that I'm going to tie together and paint a picture. What I'm painting is a commodity bull market that is coming from structural inflation. But some people, I still don't think they believe at some of the price targets that people put out. I know that I talked with Patrick and he had a price target of gold out in the future, maybe a decade or so ahead of us, of between $6,000 and $30,000. I know it's a wide range, and I know people are saying, yeah, right, disbelieve it, because what they're seeing today is weakness in the markets. But this is a roadmap. It's a big picture view. And that big picture view is what allows, I think, more experienced investors that are patient for those market conditions to play out and for those prices to realize themselves under those market conditions. Assets get priced differently under different market conditions. The market conditions that we are seeing in the markets are changing. And I think a lot of people can relate with that, even in the short term. What we're seeing is inflation, and we're seeing interest rates go up, and we're seeing the stock market roll over. We're seeing people sell bonds en masse, and we're seeing all of the signals that a trend line is breaking in multiple markets across the board. It's not just one thing. It's all interconnected. Technical analysis is fundamental analysis. The market conditions are driving all of this. So when you look at this, it's painting a picture that a commodity bull market's coming. And one of the things that you want to do as an experienced investor is, well, how big can this be? What are the psychological thresholds of the past, and what does that look like in the future? Because that'll get you your risk reward scenarios, and maybe even look at the probabilities of those happening. So, obviously there's some good investments that we can get into that are low risk with good upside rewards. And then there's ones where you can swing for the fence where the risk is a lot greater, but the rewards could be a lot greater. And constructing a good portfolio with a strategy, with portfolio allocation, is all important to, I'll say, maximize what's in front of us for opportunities. So what I'm going over right now is the one portion of getting kind of the big picture right. The second portion, which also makes you incredibly successful for this bull market, is selecting the companies, putting a portfolio together, and all that stuff. Now, I can't give financial advice. I've got my opinions on how to construct a portfolio and the companies and risks that I'm willing to take. But what I can do is in the website, the finding-value.com, on the Platinum membership, I can show you the companies that I think are highly leveraged plays for this upcoming bull market, and ones that I think that hold good risk reward. You're going to have to make your own decision on how much you want to buy and the allocation and the strategies, but you can at least see what I'm doing and why I'm doing it. So let's dive into the first big macro picture to give you guys a big picture view. Now, I took some of these charts. Some of them are Patrick Karam's. I know he was getting some people responding to some of his posts saying that $6,000 to $30,000 gold prices are ridiculous. But I'm going to go over and show you what the data is. You guys can determine if it's ridiculous or not. It doesn't really matter to me. And I'll obviously interject all my financial opinions in here. So let's dive in and see what I've got. I'm going to start with the big picture view that Patrick did. I think it's a good representation of the market conditions. And there's a couple of things that I want to tie together, and hopefully you guys can see that in this clip and presentation that I am giving here. So this is a 100-year pitchfork. This is the S&P 500 versus the producer price index. The S&P 500 is it's the 500 largest companies, something on the lines of that. And then the producer price index it's the inflation that the producers see. So think of it as like commodity inputs to the producer for producers. So think of that as kind of like commodity prices and the costs of those producers. So that could be energy costs. It could be anything like that the producers are seeing. What we see is when the producer price index outperforms, you're in an inflationary environment. You could almost say by definition, that's kind of what it is. And then the S&P 500 underperforms during that time frame. So what we're basically gauging in this picture here, or this chart, is the market conditions. And the market conditions tell us how asset prices get priced to some degree. It's kind of like the big overall macro picture that people should be paying attention to. And what we've seen is we've seen the producer price index outperform at the white arrow down to the red arrow. So this was 1930-31, or I should say 29 was probably the peak, but it's the 30s all the way to the mid 40s that it really started to outproduce, where the producer price index outperformed the S&P 500. The other one was from 1968-9, we saw a nice good move lower into the 1980s. That was a good spot to be for inflation commodity type investments. And we had another one from 99, 2000, 2001, all the way down to 2008, 2009, 2011. And now we've got another one where we've got a turn in 2020, 2021. What this means is that we are coming into an inflationary environment, and this here is information telling us that we are in fact going into an inflationary environment, that the S&P 500 stocks are going to underperform the producer price index. It is a set of conditions that are telling us that something is going on, that we could have a decade or more of underperformance of the S&P 500 against the producer price index. Now, when I look at this from a big picture view, let's strip out the producer price index to see what this looks like with just the S&P 500. What does it look like from 1929 on, from 69 on, and from 2000 to 2009 or on or so? So when you look at that, what this really is these large consolidation periods in the S&P 500. 1929 all the way to the late 1940s, early 1950s. We had another one from 1969, and it broke out in the early 80s. We had another one from 2000, 2000's the tip here, 2000, 2001, all the way to the breakout of 2012. What those are inflationary timeframes. I call them the expansionary phases of real estate because that's where the money is generated. We went into an expansionary phase of real estate here. We've had aggressive interest rate tightening. We had interest rates moving up here. We had interest rates massively moving up here. And then here, this was, we'll call it a depression, and money was revalued at that time. So there were commodity booms in these consolidation periods. And what's coming up is another consolidation period. It's an expansion phase of real estate to kick it all off. That's kind of the driver, the demographics, expansion phase of real estate, and that inflation coming from new loans. And it could also be tied with a large credit cycle where they need to print money in order to remain solvent. So they're going to try to, we'll call it, print enough money to lessen the debt in the system. So we also have that at our back as well. So we've got the S&P versus producer price index falling, which is a commodity signal that commodities will outperform. We got the S&P 500 going into a consolidation phase, I think, and we can see that the commodity super cycle, if you were to look at this, we had consolidation periods, breakout, consolidations periods, breakout, and a consolidation period, and we're breaking out of that consolidation period. So what I'm doing is I'm weaving together a story using data. And what the data is suggesting off of these three charts, and I've got a lot more behind this, is that we've got the S&P versus the producer price index saying commodities bull, inflation. We've got the S&P 500 rolling over, screaming that we've got higher interest rates and that we're struggling to move higher. Then we've got commodities breaking out at the same time. So that's all data saying from a technical analysis and a fundamental analysis, because the fundamentals are driving all of this. The technicals are just validating those fundamentals. And what it's saying is that we're coming into a commodity supercycle for a variety of reasons, and that we're breaking out of these consolidation periods. Now, when you look at this, and this is another chart from Patrick Karam, this is the ratio defined targets. What we're trying to do is we're trying to say how, if we were to look at history, what is our potential limits? Where could we go given history? Now, looking at history, all this is a ratio of the value of gold versus the S&P 500. And think of the tops and bottoms as psychological threshold points. The bottom is around, somewhere in this range at 0.35, 0.27, something in that range. And at the top, we're at 7.4. It's a very large range. In the 1970s, we went from a very low ratio all the way to a very high peak. The question you need to ask yourself is this: why? What market condition in this era forced the participants and humans in that market so that gold would outperform the S&P 500 by that amount? Why did it do it? And when I go back and I look at the market conditions, remember, assets are priced based off of the market conditions. And when I look at the 1970s, we had the energy crisis in 1970, and we had a larger demographic with money coming into the system of the baby boomers coming into home buying years. The market conditions under that time, with the increasing interest rate environment and how fast those interest rates increased, think of it as a transition period of a fast rate of change of money supply growth and a constraint in commodities and energy in particular. It was peak oil of America. And the market conditions are what drive these ratios up and down and the extremes of those ratios. So the extreme of that high there was money in the system, the persistent inflation over the past 10 years, and the psychological changing of human beings and herd mentality in that market. It started with an energy crisis and money coming into the system from the demographic into home buying years. That was the market condition. Then the demographic ran out. It wasn't interest rates, in my opinion, that killed this. It was the demographic that ran out, and the inflationary pressures subsided. The interest rates were nothing more than riding along the coattails of the demographic. It wasn't necessarily the driver of this. It was the thing that was riding the coattail. So we got up to this ratio here, and another thing I want to talk about is this was America-based only. The world was not in its S-curve of demand consumption of energy. It wasn't nearly as progressed in terms of the mines and the ore grades. Like, we still had and could tap into lots of oil, lots of mines around the world. There's a lot of, we'll call it a fruit, low-hanging fruit that we could hit up on a global scale. So this could also be resolved in this time frame and suppressed to some degree with GDP growth, with oil and commodities around the world. We could expand and grow globally. We went into a large disinflationary period. We broke out of that early breakout line in the 2000s. This was a mini demographic move coming up into home buying years. Now, another thing that you have to think about during these up cycles here, where gold is outperforming the S&P 500, a lot of those times interest rates are going up. That means that bond prices are going down. Bonds are selling off. And what you'll see is countries start to stockpile commodities during these timeframes in the beginning and doing infrastructure packages in the beginning of it because they can't recycle their money back into bonds and make any money. They will lose because bonds are going down in price and interest rates are going up. It's a function of the demographic and a function of the market conditions during those timeframes. And this here is the real estate cycle. We went into a boom in real estate. We were in a kind of a more of a bust type region in this era with a declining rate of demographic. The growth rates were declining. It was still growing, but the rate was declining. This was a little mega boom, we'll call it, in a mini cycle. And then we came back down and we're at a very cheap level again. Now, the risk reward here of gold versus the S&P 500 is off the charts in favor of gold. We've got low downside risk, great upside potential. That's where I like to be. Now, we're looking at this from a very long-term perspective. We're looking at this from 1960 all the way till today. The day-to-day movements are going to be there no matter what. It could look like we are wrong over the next month or two. But if you take a big picture view, and when we break this trend, which we will, and the reason I'm confident we will, is because everything else is broken. All the other trends are broken. Oil, you can use oil, you can use all the other trends, and gold is usually last. You already have a pre-map to what this thing will most likely do. Now, I'm not going to say most likely because no one knows 100% sure, but all of the leading indicators are breaking out, and this is the laggard. Now, during this time frame of 2008, when we had that crash, we printed a bunch of money. It went into the system, but it never got loaned into existence. It never got in the hands of people. The money exists in the system, but it's in financial assets. It's in bonds, it's in stocks. And that's why we got such a low ratio of gold versus the SPX at this time frame. The money wasn't in gold, it was sitting in the S&P 500. Now, when we get these certain market conditions, what happens is the money starts to rotate and it changes its preference of what assets to go into. And it's changing its preference into gold. What this is telling us, or the potentials here, is if we get the same market conditions as the 1970s, which we've got the millennials coming into home buying years, and we have a global energy crisis. Tell me that doesn't sound the same as baby boomers coming into home buying years, and just America going into the energy crisis, peak oil of 1970. We've got the entire world doing this, which means, and I'm not trying to be too ridiculous here, which means we could even beat the top of this ratio because the market conditions could, I say could, be more severe than the 1970s because of the energy crisis being global and the crisis of currencies happening globally. So this here is a small demographic participating in a boom of a expansionary phase of real estate, in an expansion of money supply, and in an energy crisis only contained to America. What's coming over here could be a gigantic move and much larger based off of the number of participants in the world and the number of participants that are going to experience bond crisis, currency crises, and the energy crisis all tied together. People in 1980, if you look at the movie Rollover in 1981, they were worried about a currency crisis. It's going to happen over here as well, in my opinion, at least. And what he did is he just said, well, we were basically breaking that level 8 years, 10 years, 10 years. And he took those levels and just said, well, if we break and make a new high, what would that be? If the SPX is 400 and you take the ratio, 1.66 times 4,000, you get 6,400. 7.4 times 4,000 is 29,640. These are just price projections based off of the psychological levels during those certain market conditions throughout time. He's not doing anything where he's just pulling these numbers out of the rear end. This is actually a pretty brilliant way to do it. I do it using ratios just like he does, and he's even putting on there the historical moves that we saw, and you could maybe even use a little bit higher than 4,000. Now, the question is, are the market conditions on a global scale of an energy crisis and people being worried about currencies stop this price at 29,640? I don't know. That might be low. Now, here's another thing. So we're looking at this. This is the the gold to base money supply. Here's more evidence backing what he thinks. Patrick and myself, I think this as well. Back in the day when we had a gold standard, it was really going around 3.5, 4. That's 3.5 to 4. Right now, we are down at I think it's like 3.5, 0.4, 0.35, something like that. If we were to go back to levels that were up here at 3.5, that's a 10x increase. 10 times the price of gold today is about what? 20,000, 18,000, something on the lines of that. Now, that is also with them not printing money. If we start to print more money, this ratio is going to go up. The price will go up. The ratio will stay the same, the price will go up. So if they print more money, it'll be 30,000 by then, 40,000, 50,000, 80,000. It's all priced in against whatever that money supply will be in the future. I don't know what that future money supply will be, but I can tell you we're growing at exponential speeds. We are hockey sticking higher. And we're at ultra low, gold is at ultra low levels against everything. Now, I'm not trying to make a case for gold. What I'm trying to do is I'm trying to make a case for commodities because everything is tied to gold. So I've got data here saying that gold is cheap to the money supply, gold is cheap to the SPX, commodities are just starting to break out. You tell me why I should be bearish on any of these things. And the risk-reward levels are through the roof. Here's 100 years of commodity valuation. There's things that I want you to keep in your head. The bottom of this ratio bottomed in the 1930s, early 1930s. This basically bottomed in 1969. And this is bottoming in 2020, 2021. Now, what do we see when we start looking at all of these charts? The 1930s is off this chart. 1969 is right here. We went higher. This was the 1970s bull market. This was the 2000 to 2011 bull market. And we're coming to a big boy coming up, I think. What do we have here? 1930s off the chart here. 1969 is in this area right here where it gave us the buy signal. We had a little bit of riding sideways before we rocketed higher in gold. It's part of the game, guys. You got to be patient. Down here, 1999, we got that buy signal. The buy signal in 99 was right here. And there's your buy signal in 99 right here. So you have to ride it up, and then you ride it on up, and you sell it when it's at the top. We are getting another buy signal in 2022, 2021 in this area for the commodity to stock ratio. It came all the way back down to here. Now, what about other charts? What can we see? Look at the long-term charts of tech. Tech versus the S&P 500. 1969, top and rolling over. 2000, top and rolling over. What do we have here? Top and rolling over. The data all aligns, guys. It all aligns with the market bottoms here, the topping of this ratio, and more or less, these are just inverse related patterns. What about the old economy? Look at where the money is and isn't. It's stuck over in tech, discretionary, and communications. All that money they printed went into financial assets, and it went into tech, discretionary, and communications in a low inflation, low interest rate environment. It chased itself all over there and created a massive bubble. It's not in energy, materials, and industrials. That coincides with this, which coincides with this, which coincides with this, and coincides with this, and coincides with the breakout, and coincides with the overall consolidation with the S&P 500, and coincides with the SPX to producer price index. All in alignment. So we also look at some of these 60-40 portfolios and the worst returning years in the past 100 years. It is of no surprise that 1930, 1969, 1970, and today, all in alignment. They are all in alignment with the commodity to S&P 500 bottoms. It just so happens that all of this data aligns. Then we look at the U.S. stock to bond returns, similar to what we're looking at here, just in a different format. 31, 69, 2022. 3169 2022. Wow, they all align. There's no way that this is possible, guys, right? What about the global liquidity index and long-term cycles? What happened in 1970? 1970, we increased in our global liquidity index. Then we had a pullback. In 2000, what happened? Global increase of liquidity. What happened in 1969? Oh, yeah, I already did that one. 1969, 2000, and look where we are here. We're at a global liquidity index of long-term cycle at a very low level that's about to turn up. We are at a low level. Now, I'm not saying that I know the exact timing of when this turns up and goes, but guess what? It's at a low level. So the risk here is low because we're already at a global liquidity index that is low. It's not a liquid market at this time. And guess what? It's going to probably cycle back. And if I were to take a guess, it's going to be because of the bond market, a bond market problem. Interest rates aren't going to slow this thing down. They're going to break the bond markets, and then eventually they're going to have to print currency to keep them solvent. That's my guess. Then you start to look at the winners of these environments, these stagflationary environments. In the 1970s, with an energy crisis and a demographic and money printing, where's all this money going to go? Goes into energy, guys. Energy does very well in that type of environment. Value, small cap REITs, commodities, and real estate. And energy being some of the best investments. So when we go and we look at energy, we look at the inventories of energy, and look what happens. This is the 2020, we went into a large increase of inventory during the shutdown, and then we started eating through it, and then we came in and ate through 2021 in the yellow, and now in the green is 2022, and we are eating through our inventories at a very fast pace, and we're at a very low level of total inventories. This is ultra bullish for energy and for precious metals. Ultra bullish, because when we had the 1970s, we had a energy crisis and a lot of money. Today, we're seeing that we could potentially have more liquidity enter the market soon for whatever reason, and we've got low inventory levels of energy. And I think this is going to get much worse. We've had the Strategic Petroleum Reserve releases. They've been trying to slow this thing down. They are doing it for political purposes. That's at least my opinion. And they're trying to hold the inflation rate down. That's why we're seeing some relief in the inflation numbers for energy. But it's not done. It's not done. When that liquidity enters the market, there's not enough energy in the system. GDPs will go down because we don't have the energy to support higher GDPs. And inflation is more or less the difference between money creation in the system and energy. Energy is what grows economies. That is the driver. Money is not. Money is a tool for future energy consumption. Money is debt. Debt is a future repayment, and a repayment needs to be paid with the consumption of energy, either a final product or a commodity of some sort. Now, when we look at the investors' intelligence, bulls and bears, the ratio, we are super bearish right now. I think this is looking very good for potential investments that are out there. We can see the Dutch inflation rate surpasses the 1970s. We can see inflation is kicking this thing off pretty hard. We can see agricultural commodities starting to break its downtrend. It's right there at the downtrend. Remember, these guys run, they hit a resistance level, and then they sit for a little bit. They do a back test, and then they run again. Now, I know some people, they say, well, the investments aren't going this second. You got to be more patient, guys. You gotta level up. Now's the time to level up. You've got opportunity sitting right in front of your face. Do not be a newbie investor. Throw that in the garbage. Get yourself leveling up and look at the big picture view. This is where big money's made. Big money is not made by looking at stuff week to week. It's made by looking at what I'm looking at right here. Performance by sector since the S&P 500 peaked, energy up, everything else down. Now, if you look at some of these environments here, I'm going to go back real quick. The environment that we were looking at on the ratio defined gold targets of the gold and S&P 500. This market condition, you know why this went up so much? Where gold outperformed the S&P 500 so much and why it went to the level of 7.4? It's because in that system, only a few things worked. Large sums of money coming from the bond market and coming from the stock market rotated into precious metals, energy, and commodities. That is the same scenario that's coming up here in this future. It's the same exact thing. So that is what you have to be thinking about. You're thinking about the market conditions and where money can flow. Because if money can't flow into stocks and it can't flow into bonds and it can't flow into a lot of the companies because of energy shortages, what that means is less things will work in the market. It means that money has less options that will work and that the money flows will be greater and these ratios are going to be pushed to further extremes. So we go back into this. We've got the inflation rate going crazy. We've got all these patterns breaking out. We've got energy outperformance and the rest, outperforming the rest. And then we've got, and I just put this here, is the S curves of some of these countries are going to start going through and consuming much more energy. China, India, and this is Latin America. It's going higher here, all the way since 2020 and upward. So the market conditions here are absolutely fantastic for a gigantic move in all of these commodity type of investments. I'm looking at energy quite deeply. I'm looking at precious metals, physical metals, and I've created my website to talk about those areas and what I think are the best investments in those areas. And I've dug into and looked at the charts, looked at the fundamentals. This is very important to understand. You got to get in this. You got to get the data. You got to look at this big picture view. You got to tie it all together. And then you got to spend your time focusing on what you think are the best sectors. Energy related investments across the whole board, I think, because if energy is the problem, what's going to happen if you think logically about it is investment money is going to chase returns. If the normal person is going to spend more money on food, housing, and energy, and the money is going to go to those three things because that's basically lower on, I can't remember the guy's names, pyramid, whatever pyramid it is, Maslow's whatever pyramid. Money's going to flow to those first, and that's going to probably be, in my opinion, the best areas for investment. That is what I focus my energy on, because when this rotation happens of money flows, it's going to aim right at those because that's who's going to be making money. If the regular person can't buy other items, they're going to flow it into those areas. Hopefully it's not bad enough where people start to riot. They might, but that's where the money will flow. And a protection of your wealth might be necessary if the currencies can't handle the pressures in the system, the unwinding of all this money. And that's where I think the greatest opportunities are. Energy, precious metals. If you guys need help in figuring this stuff out, definitely sign up to the membership, platinum membership, for help on selecting potential companies. You guys can view whatever I have. You can see my portfolio. You can see how I'm positioning for it. The way that I've selected my companies, and I'll just kind of the way I selected some of them based off of different criteria. Some might be the reserves that they have in exporting countries, what I think will be still exporting, how much growth they could have in the production of oil, natural gas, or whatever it is, if they've got hedges in place or if they don't. If they don't have hedges, they are completely exposed to the price rise. If management teams are actively looking to not hedge and to take advantage of this large bull market that's coming up, I want them to have the same viewpoint as me. I want them to have solid balance sheets. I want them to buy back their shares, and I want to have dividends in the future. And I'm trying to find that alignment where they have large insider ownership, they've got good reserves, they can grow production, on and on and on and on. I look at energy service companies. I'm looking at uranium companies because I think nuclear will be a solution to this new world. And I'm looking at physical metals and some of those areas of how to play that. So that's what I've got, guys. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And we'll catch you next time. This is Finding Value.